Now, when they come to divide profits out between the partners, there's got to be a concept of fairness. So while it would sound logical, let's split the profit between them, that might not be the fairest way, because maybe they had different capital amounts in the business. So for that benefit, to compensate the person that has got more, we will then first of all give them an interest on capital. Maybe some of the partners work longer hours than others. Maybe one of them is a part-time, the other one is full-time. So is it fair then that they share the profits? So in that case, we will also give them a salary, and it is possible to give them a bonus. Now learners, what I need you to understand, although I'm talking interest on capital, salary to partners, bonus to partners, these are divisions of the profit. What profit has the business made, and how are you going to divide that out? Now I'll bring that all together in a minute. So partner A is earning an interest, he's earning a salary, it's increasing his current account. Likewise with partner B, it's increasing his current account, so we would have the entries on the credit side. The double entries for all of those would, following logic, we will now bring into our books new accounts. The interest on capital, and it went into two different accounts, the current account of A and current account of B. Remember, these are ledger accounts, so the details must be the name where the double entry is. Salaries to partners likewise went to A and B, and bonus to partners only B earned. So there's your double entry. Debiting the expense accounts, what are we dividing out the profit in, how are we dividing it out, and who does it belong to. Now just one thing I need to draw your attention to, learners, is I've used salary to partners and bonus to partners here. That is perfectly acceptable, but there is an alternative. You could have a salary partner A and a separate ledger account salary partner B, and the same with the bonus. Now if that's the way you're going to write it, then you'd have two accounts, and over here you would not write salary to partners, you would write salary partner B, and a separate account salary partner A. So again, you need to see what your teachers are teaching you and how it is in your textbook you're following and what examining board that you are actually following. Now, as I said, these expense accounts have been created. This is what we are going to pay out to the partners. But, let me say it again, this money has to come out of profits. This is what the partners have already decided in advance when they entered a partnership agreement. So they decided how they were going to pay out their share of the profit. Now, that brings in a new account to us, and that is called the appropriation account. Now, the word appropriate means to divide. So, on the credit side, this appropriation account is an extension of your final accounts. Your profit and loss account will be closed off and brought into the appropriation. Remember, in a sole trader, your profit and loss was closed off to the capital because all the profit belonged to the owner. But now when you're in partnership, we now have to bring in an extra account in the final account section, which is our appropriation account. So the first thing coming in is from the profit and loss, and take note, I'm writing profit and loss because that's where the double entry is, and I've made a net profit of 480,000. Now, out of that, we are first of all, our first distribution, our primary distribution, is to pay out these amounts here. They're primary because they're the first, and they were pre-decided by the partners. So what you're going to do is you're going to close off each of these accounts here, and this 30,000 will get closed off, and that's it, finished. Now you might recall that you did this in grade 10 when you had all your expense accounts, and you would have closed them off either to a trading or a profit and loss account. We're doing exactly the same, but we're closing off to the appropriation. So I've done the same. I've closed off all of these accounts, so they're not there any longer. It's the end of the financial year. These amounts are coming out of the profit, and the double entry, they would have gone into the appropriation account. So debit side is the minus. So you had 480,000. You've now paid 30,000 out as interest, 210,000 out as salaries, and 15,000 out as a bonus. Now, at this stage, if I have a look, those amounts there add up to an amount of 255,000. Right. But I had a profit of 480,000. So what have you got left? What is the remaining? How much profit has still got to be divided out? And if you subtract this, this comes to 225,000. This is called our secondary distribution. We do it second, or our final distribution. Now again, the partners would have decided how they're going to pay this out. And there are various ways. They could do it in a ratio. They could do it in ratio to their capital balances. But for convenience at the moment, I'm going to say they're going to share this equally. So this remaining is going to go to each one of them separately. And so into the appropriation account, I will give each one of them half of what's remaining. Now this is a very common mistake. Learners always want to go back and take the 480 and divide it. Remember, you only had 480. You've already paid some amounts. So you've only got a part left over, 225, and they are sharing equally. The double entry at this goes straight back to their current accounts. We don't open up another account for share profit. The double entry for that is going back into their current accounts, and so into their current accounts we will bring in appropriation. And so they're earning this money. It's a double entry from the appropriation. It'll be adding on. And remember, the double entry is appropriation because that's where it's coming from. So this partner had an opening balance and he's earned more. He's got an amount of 292,500. But he's already taken some of that money. And so, as we saw earlier, we'll close the drawings off to his current account. This is what the business owes him. This is what he's already taken out, and therefore he's still got a balance which will start the next year off. It's a credit balance, so the business owes him this money. It's up to him to decide what he wants to do. He could draw it all out now, or he could leave it in the business, and that would be extra capital for the business. And exactly the same you will do with partner B. So he'll bring in his share of the profit, his appropriation. He's already taken some drawings out, so the amount that he is owed at this stage, again also a credit balance, so the business owes him. Now if you're doing ledger accounts, the double entries here are very, very important, so you must focus on that. Right, it is possible, just as a last thing, that these current accounts could have a debit balance. If a partner drew out more than he was entitled to, then he would have a negative balance. He would have a debit balance, and in fact he would be owing the partnership money. Now grade 11s, you need to get to understand these accounts. You need to understand in particular the current accounts. The 3 new expense accounts, which is the double entry for the current account, and the fact that these then get closed off to the appropriation account, which is a totally new account to you. Now, as you're working through the exercises in your book, concentrate on your double entries and dividing the amounts out correctly.